Sorry about Here we are. I hope everyone can hear me now. Sorry, everyone. So thanks very much for joining us. My name is Veronica Marson, and I'm the events director at the Canadian Hispanic Bar Association. We're very excited to bring you our Accounting 101 workshop today. It's a lawyer's guide to financial literacy. Thank you very much to our friends at Deloitte for being with us today and preparing this fabulous presentation. The webinar today is intended to give you an overview of different financial concepts in business and as well as techniques used in litigation accounting. Couple points of housekeeping. So first of all, this program's eligible for 1 hour and 45 minutes of professionalism hours from the Law Society of Ontario. If you have any questions during the webinar, feel free to type them in the Q&A section, which should be at the bottom of your screen. I know we won't get to all your questions, but we'll do our best to do so as we go along. And without further ado, I'd just like to introduce our speakers. So our first speaker, her name is Katherine Furlan. She's a senior manager at Deloitte's Dispute Advisory Services practice. She holds a Bachelor of Business Administration from Wilfrid Laurier University and is a chartered professional accountant and a chartered business valuator. She's also certified in financial forensics by the American Institute of CPAs. Welcome, Katherine. Our second presenter is Natalia Raimondi. She's a senior associate at Deloitte's Dispute Advisory Services practice. She holds a Bachelor of Economics from York University and is a chartered business evaluator candidate. Natalia previously worked in financial services, specializing in wealth management. So I'll hand it over to you now, Natalia and Katherine. Thanks so much.
Thanks so much, Veronica. Hi, everybody. Thanks for joining us this evening. We're delighted to be hosting this webinar on financial literacy for lawyers in partnership with the CHBA. We thought this was an important topic to speak about because financial literacy is so important in so many aspects of life, be it personal, work-related, or even just investing for your own future. So we've been planning and looking forward to this for some time. And while COVID has posed many challenges, I'm happy to say that it didn't prevent us from engaging with you today. Before we kick off, I wanted to thank Veronica, Antonio, Wendy, and the rest of the CHBA board members that worked so hard behind the scenes to facilitate today's presentation. And before I get into the agenda, I'm just going to further make some introductions and put names to faces. So, as Veronica mentioned, we work in Deloitte's Dispute Advisory Services, which falls under the forensics group at Deloitte, and that falls under the broader financial advisory service line. Katherine Furlan on the left joined Deloitte in January from a boutique forensic accounting firm. She brings 9 years of damage quantification experience to the practice. And her practice areas include business interruption, commercial litigation, shareholder disputes, matrimonial disputes, expropriation, and personal injury. I'm Natalia, I'm on the right. I'm a senior associate, and I previously was at a mid-sized litigation accounting firm, and I have 5 years experience in this field, practicing in personal injury disputes, commercial litigation, shareholder disputes, business interruption, etc. So the agenda for the day is as follows. Katherine's going to be presenting the financial literacy component, which will provide an overview of the basic financial statements and, more importantly, how to interpret them using ratios. I'll be presenting the business valuation and litigation accounting component, where we'll discuss an overview of business valuation theory and normalization adjustments, what they are and when they're appropriate, and we'll provide you with some examples of techniques that we use. So the idea is to arm you with some simple steps you can take to understand whether there are any red flags in the financial statements in question so that you can make an informed decision on how to manage the file moving forward and whether the file warrants a closer look or an accounting expert's analysis. So we wanted to make this quasi-informal, which can be a little bit tricky with this many people on the line. So as Veronica mentioned, please feel free to post any questions on the Q&A portion, and she will be monitoring that and posing the questions. And if not, we've got a Q&A portion at the end, and we can take any questions there. So I'll just hand it over to Katherine.
Thanks, Natalia. All right, so I'm going to dive right into it with an overview of our basic financial statements. I want to go to the next slide. So our basic financial statements. First off, I want to just go over what financial statements are. So they represent a formal record of the financial activities of a business or an entity. They quantify the financial strength and the performance and liquidity of a company. So there's a few statements that you should be familiar with. The first one is called the Statement of Financial Position, or the balance sheet. And the balance sheet represents the financial position of an entity at a given date. The next one we have is called a profit and loss statement, or also known as an income statement. And this reports the company's financial performance in terms of profit or loss over a specified period of time. So for example, the profit and loss statement for the last 12 months. And then the third statement we have is called the cash flow statement. And this statement presents the movement of cash and bank balances over a period of time. And the movement of cash flows is typically classified into 3 categories. So the first one is operating activities, and these would be the cash flows from the primary activities of a business. Then we have investing activities, and these are the cash flows from the purchase and sale of assets other than inventory. And then the third category would be financing activities. So those are any cash flows that are generated or spent on raising and repaying capital of the business, together with the payment of interest or any payment of dividends. Another thing to note in financial statements are the footnotes and the disclosures. So these include qualitative information that coincide with the data that are included in each one of those 3 statements I just mentioned. The notes are full of a lot of really important information that help interpret the financial statements. They can include details behind any loan agreements. So if a company has a loan, the note associated with the loan would include the term of the loan and the interest rate that's payable. It might also include a note on how the company is valuing inventory, because there's a number of methods that are used depending on the business. And it also might include any information on what is called subsequent events. So subsequent events are any event that occurs after the balance sheet date, but before the release of the financial statements. So there can often be a lag between the balance sheet date, let's say that's December 31st, between when the statements have been reviewed or audited. That may have an impact on the financial statements, and those events would be disclosed in the notes to make the reader aware. So we're going to talk in more detail about each one. So starting off with the balance sheet. So again, this is at a specific point in time, and it has 3 different elements. The first one would be your assets, which is something that a business owns or controls. A couple examples include your cash, your inventory, any plant and machinery owned by the business. The second category would be the liabilities, and this is something that a business owes to someone. So that could be their creditors, it could include bank loans, things of those nature. And the third category is our equity, and that is what the business owes to its owners. So essentially the equity represents the amount of capital that remains in the business after the assets are used to pay its outstanding liabilities. So it's essentially the difference between assets and liabilities. So on the next slide, we actually have an example of a balance sheet. So this balance sheet is an example for a company that's a conglomerate of restaurants, and it is at a specific point in time. So this is at December 31st, 2015. So I just want to draw your attention to a few different things on this balance sheet. So the first thing I want to note is that the 2 sides of the balance sheet, the left side being all of the assets and the right side being the liabilities and the equity, they must balance, hence the name balance sheet. So you can see in this example, Total assets is 321,000, and the liabilities and shareholders' equity on the right side is 321,000. Your first check, if those two sides don't balance, there's something wrong with their reporting. A few interesting items on the balance sheet. So on the left-hand side, under assets, the last line there, the intangible assets, I just wanted to speak briefly about what that means. So essentially, it's an asset that is not physical in nature. So an example of that could be any goodwill that's held in the business, any brand recognition or intellectual property, such as patents and trademarks or copyrights. So essentially, these assets do not have a physical presence, but they carry long-term value for the company. Another thing to note is that the assets and the liabilities can be categorized into current and long-term. So you can see the assets are split here. We have current assets at the top, and then we have a few others at the bottom, including property and equipment and other assets. So current just means that the asset can be easily converted into cash within 1 year. And long-term assets have a useful life longer than a year. On the liability side, it's the same idea. Any current liabilities are liabilities that are due within 1 year, and then long-term is anything due after the fact. In this balance sheet, we also have an interesting item called restricted assets. It's around the middle. It's the last one on the current assets category. So restricted assets are typically cash or another item of monetary value that's set aside for a particular purpose. So primarily used to satisfy regulatory or contractual requirements. So they're not used for the normal operations of the business. They're set aside for one specific purpose. The last thing I wanted to just draw your attention to was retained earnings. So this is on the right-hand side under the shareholders' equity. You can see it's circled in blue of 131,000. So retained earnings is essentially the amount of net income that's left over for the business after it has paid out its dividends to its shareholders. So the profits of a business can be paid out to shareholders in the form of dividends, or they can be reinvested back into the company for growth purposes. So any losses or dividend payments would reduce this amount while profits would increase it. So now we're going to move on and discuss in a little bit more detail the income statement. So the income statement is made up of generally two categories. You have your income, and then you have your expenses. So income is pretty straightforward. What did the business earn over the specific period of time? So we're looking at the sales or the revenue activities. And then the expenses can be broken out into a few different categories. So here we see right under revenue, we see cost of goods sold. So these are expenses that are directly related to producing a product or service for sale. So for example, in a manufacturing business, you would see the raw materials that are used to produce whatever the product is that they're making. All of those raw material costs would be included in the cost of sales. So they're directly related. Then we have operating or non-operating expenses, and these fall below the gross margin. So operating activities are all of the costs that you incur to bring the product or service to market that are not directly related into the product. So for example, rent of, let's say, if you're renting out manufacturing space or any other rental expenses you have, that would be considered here, as well as wages and salaries. Non-operating activities are not related to the normal business operations. So examples of non-operating activities would be like your interest expense. If you had any restructuring activities happen during the year, those associated expenses would be considered non-operating. If a one-off lawsuit was settled and there was an expense associated with that, that would be another example of a non-operating expense. Okay, so the next slide has an example of an income statement. So this is for the same example company, the conglomerate of restaurants, and it shows a comparative 2 years. So we're looking at 2014 and 2015. And so a few points to focus on when you're looking at an income statement. I typically start off at the top and work my way down. So I'm looking at revenue, and I just want to get a sense of what happened between these 2 years. So you can see that in this case, revenue actually increased from 2014 to 2015. So we see restaurant sales, the top line there, increased from 355,000 to 460,000. So that's, or sorry, 460 million. So that's great. And I would want to understand what's causing the increase in the revenue. Then if I'm working my way down the expenses, I want to see, are there any major changes year over year? Is there any, weird expenses or any outliers, any major changes that are jumping out at me? And so those are items you'd want to pay attention to. And then the last important piece would be to look at net earnings, which is the last line. So you want to assess, is the business profitable or are they incurring losses? So we've discussed the main components of the financial statements. Now we're going to dig a little bit deeper into what to actually look for and what the numbers mean. So here is a cute little accounting joke. And this is where our ROI, so return on investment, became an IOU. Okay, great. So we're just going to dive into the next section. So the next section is ratio analysis. Ratio analysis, it is a quantitative method of gaining insight into a company's liquidity, its operational efficiency, and profitability by looking and studying the financial statements. So we're going to discuss in detail each one of these categories of analysis to help you understand, what you can look for to gain a better understanding of a company's operations. So we'll start off with profitability. Profitability ratios. These consist of a group of metrics that assess a company's ability to generate revenue relative to its revenue, operating costs, balance sheet assets, and shareholders' equity. So essentially what it's showing is how well companies use their existing assets to generate profit and value for its shareholders. There are a few common profitability ratios, and they include one is called a gross margin ratio. So this compares the gross margin of a company to its revenue. Then we have an operating margin. This highlights the operating income of the business as a percentage of revenue. So what that means is it's the contribution of the company's operations towards its profitability. We also have a ratio called return on assets. This one shows the percentage of profit a company earns in relation to its overall resources. And then we also have something called return on sales. This is a measure of how efficient a company turns its sales into profits. It's useful when comparing companies in the same line of business and of roughly the same size. So on the next slide, this slide is taking our income statement that we looked at previously, and I'm going to run through a few examples in more detail of what I would look for. So the first thing is this company profitable? And so when I look at the revenue, like I mentioned, the restaurant sales increased from 2014 to 2015. So it goes from 355 million to 460 million. It's a pretty significant increase, and I want to understand what contributed to that. So I want to know, like I said, it's a conglomerate of restaurants, so how many locations does this business have? I get this information from the notes to the financial statement. So you can see on this slide here in 2014, in the top left-hand box there was 150 company-owned restaurants in 2014, and that number increased to 200 locations in 2015. So that is and then when we take the restaurant sales divided by the company-owned restaurants, we're calculating the revenue per location. So you can see from 2014, the revenue per location is about 2.4 million compared to 2.3 million in 2015. So it's not a huge decrease. I would consider that relatively flat. So what that's telling me is that the revenues are increasing because the locations are increasing, and the revenue per location is staying relatively the same. So the new locations are not taking away revenue from the existing locations. So that to me tells me that that's a good sign. This company seems to be doing well. A few other things I would look at are, they're noted here. So I would just take a quick look at their franchise royalties and fees. To get more information on that, again, I would reference the notes. It would most likely include what percentage of franchise fees is the company earning. I would take a look at any investment income. So you can see on the right-hand side, the fourth line from the bottom is the investment income. And in this case, it's pretty minor. It's really not contributing all that much to the overall profitability of the company. It did decrease in 2015, so I would reference the notes to just understand what's happening there, but I wouldn't spend a ton of time on it. Like I mentioned, it's not a huge amount. I do want to calculate the net profit margin. So this is a ratio that is essentially asking how much net income is generated as a percentage of revenue. So what this is illustrating is how much of each dollar of revenue collected by a company translates into profit. So the formula is quite simple. All you're doing is you're taking your net earnings and you are dividing that by your total revenue. So a good ratio for a good net earnings, net profit ratio will vary by industry, but a general rule of thumb is 10%. So in this case, 6.3%, and 2015 is 6.4%. So the ratio has remained the same. On average, 10% is considered average, 20% is considered high, and 5% is considered low. So just based on the rule of thumb, you would say that this net profit margin might be considered low. However, specifically for the restaurant industry, 5% is considered the norm. So in that case, this business is actually operating slightly better than the average for the industry. So that's something to always consider during ratio analysis. Is you want to consider general rule of thumb, but you also want to consider what is most common for the industry that the business is operating in. And then the last piece you would want to look at is just, are there any non-recurring or non-operating transactions or any kind of weird expense items to dig into a little bit deeper that may be impacting the bottom line, the profit. So just taking a quick peek at this financial statement, the one that really just jumps out at me is the loss on asset disposals and store closures. So it's about halfway down in that box on the right-hand side. So I would just want to understand, what assets were disposed of during the years and how many stores were closing, and ideally, why did those specific stores close? So it's just a matter of gaining a little bit more understanding on the operations of it. So the next section we're going to talk about is liquidity. So liquidity means it speaks to the availability of cash to meet its short-term operating needs. So put even simpler, it's the ability to pay your expenses and your debts as they become due. There's a couple common ratios included in this section. They're called the current ratio, which measures the company's ability to pay its short-term obligations. And then we have the quick ratio, which is just a minor modification on the current ratio. So we'll go through those on the next slide. Perfect. So exactly, how liquid are the assets? Are there enough short-term assets to cover the immediate obligations? So these figures are from our balance sheet that we looked at the beginning of the presentation. So our current ratio is very simple. It is the current assets divided by the current liabilities. In this case, we're calculating a current ratio of 1.2. A good ratio would be anywhere between 1.2 and 2. So at 1.2, that means that the business has 1.2 times more current assets than liabilities, meaning it would have the ability to pay off all of the current liabilities. The quick ratio is a little bit different. Instead of taking the entire current assets amount, it's restricted to 3 assets: your cash, your short-term investments, and your accounts receivable. So you add up those 3 items, divided by the current liabilities, and that ratio results in a 0.64 amount. So just a quick little pop quiz for those listening. If anyone is able, you can respond in the chat, but which ratio would be considered more conservative? If you just want to type in either current or quick, that would be great. Oh, thank you. Someone responded quick. That is the correct answer. So what I mean by conservative is so because the current ratio takes your entire current asset balance, whereas the quick ratio is only focusing on 3 specific assets, the quick ratio is more conservative. It's only looking at those 3 very, very liquid assets. So your cash, your short-term investments, and your accounts receivable are the most liquid assets that a company can have on its balance sheet. So the other assets might include inventory or prepaid expenses. They might be a little bit harder to quickly convert to cash, and that's why your quick ratio would be considered slightly more conservative. Good job. Okay, so our third category is our leverage ratios. So leverage means, leverage assesses the ability of a company to meet its financial obligations. A higher financial leverage ratio indicates that a company is using debt to finance its assets and operations, whereas a company with a lower financial leverage ratio indicates that even if the company has debt, like a bank loan on its balance sheet, its operations and its sales, they're generating enough revenue to grow its assets through profits. Okay, so we're going to continue to use our example balance sheet and income statement for these examples. So the first thing I wanted to point to is the breakdown between the short-term and the long-term debt. Oh, we have a question here. So I'm just going to pause to take that. So how do you know what the ratios in the industry are? So that's a great question. So as I mentioned before, the restaurant industry, the rule of thumb, average is 10%, but specifically for restaurants, it's 5%. So where does that information, come from? And there's a few different sources. So Statistics Canada is actually a really great source for this type of information. They have a section on their website where you can access this data. So you can actually look up like sample income statements or sample financial statements by industry and by size, like in terms of revenue. And Statistics Canada will provide you with like an average financial statements that includes certain ratios as well in that information. And then additionally on our end at Deloitte, we have access to a number of different sources, but we have access to a database. It's called Capital IQ, and it's a huge database that includes a whole bunch of financial information for public companies. So if we were, working on an engagement and a ratio analysis, and we were trying to get information for a specific industry, we could go on to Capital IQ, and we could look up comparable companies in the same industry that are public, and we would be able to review their financial information and their take a look at a whole bunch of companies within the same industry and determine what an appropriate rule of thumb for the industry would be. Yes, so the ratios would vary for different types of industry. Okay, perfect. Okay, so moving on. Okay, so what is the breakdown between short-term and long-term debt? So this is just a quick glance at the balance sheet. So you just want to look at short-term debt versus long-term debt. We want to get a sense of how much of their debt is due within the next 12 months. So for our example company, $641,000 is due in the next 12 months, and then the remaining $3.2 million is due after the fact. So just, at a very high level, that's a good sign. There's not a huge chunk of their debt that's due in the next year. So now I'm going to go through a couple of the leverage ratios. So the first one is the debt to assets. This ratio is going to tell you the percentage of a company's total assets that were financed by credit. So basically the calculation is, again, very simple. It's your total debt or your total liabilities divided by your total assets. So you grab those two numbers right from your financial statement. And a lower debt to asset ratio suggests a stronger financial structure. So a rule of thumb here would be 0.4 or lower is considered good. So in this case, we're calculating the debt to assets, 117 million over 321, 0.36. That's under 0.4. So just at our first glance, that looks good. Then we move on to our debt to equity. So it's a measure of the degree in which a company is financing its operations through debt versus its wholly owned funds. So again, the calculation is quite simple. Your total liabilities or your total debt divided by your total equity. And the rule of thumb here is greater than 0.4 or 0.5 would require a little bit of a closer look at the company's financial health. So, you have to consider if interest rates rise or if their revenues fell, the company may have trouble paying its debts. So a ratio of 0.58, which we've calculated here, essentially means a company uses 58 cents in debt for every dollar of equity. And so the third ratio here on this slide is debt to EBITDA. EBITDA just stands for earnings before interest, taxes, depreciation, and amortization. And the purpose of this ratio is to reflect the cash available with the company to pay back its debts. So it measures the amount of income that's generated and available to pay down the debts before it covers those interest, taxes, and depreciation expenses. Again, the rule of thumb depends heavily on the industry that the company operates in. However, very generally, up to 3 is good, and a ratio of 4 or 5 indicates increased risk. So just a quick note before we move on ratio analysis. So even just on this slide here, when we spoke about debt to assets, they're well within the rule of thumb, so that's looking good, but they're on the riskier side for the debt to equity. So the point I want to make here is you can't really judge a company's financial performance by just looking at one ratio on its own. You really want to do a wide analysis and get a whole bunch of data points that will really speak to the company's financial performance as a whole. Okay, so the next section I want to speak to is about trend analysis and growth rate. So trend analysis, it is the idea that what happened in the past will give us a good idea of what is going to happen in the future. And an item that specifically garners a lot of attention would be a company's growth rate. So when you're looking at the difference between values on a financial statement from one period to the next, it's often difficult to know which number changed by a larger or a smaller percentage than another number. So on this slide here, this is a perfect example. This is a new company. We have 3 years of income statement data, 2016, 17, and 18. We have the amounts in dollars, and then we have the percentages column. So the percentage column just represents the percent of revenue that amount makes up. So if I were to just review these income statements, I would first start off at the top. I would look at sales, and I would see from 2016, we had sales of $3 million. 2017, it increased to $4 million, and 2018, it increased to $5 million. So just off the bat, I see this company is increasing $1 million in sales each year. That seems great. Then if I look down a little bit further and I look at the gross profit line. So your gross profit is just your sales minus your cost of goods sold. So I see my gross profit has remained flat. It's $2 million each year. However, if I look at the gross profit as a percentage of revenue, I see that that's actually declining. So in 2016, gross profit was 67%, but in 2018, it was 40%. So that's a significant decline. And I would want to understand what's happening here. And so what I need to look at is the cost of sales. The cost of sales is actually increasing. It's becoming more expensive, and it's growing at a faster rate than revenues. And so we would want to understand why. Are there products becoming more expensive? Did they have a recategorization of expenses? So they're including more things in cost of goods sold in 2018 than they were in 2016. Basically, there's a few questions here that we would want to try and get answered. So if I keep moving, making my way down the income statement, I'm going to pause at the salary line. So I see that salary expenses have decreased slightly from 2016 to 2018. So they go from 500,000 down to 300,000. And their percentage of revenue has changed from 17% to 6%. So I have a few more questions here. What happened to salaries? Perhaps did some salaries get recategorized up into cost of goods sold? If we're speaking about specifically like a manufacturing plant, they might have split the salaries into like direct, laborers working on the floor versus administrative staff. So that could be a reason. Or did they get rid of some of their workforce? So there's a couple questions I would want to ask about the salaries expense. And then finally, the last thing I would look at is the net income or the loss. So that's your last line there. And again, just looking at the dollar amounts, we have 540,000 to 400,000 to 600,000. So it seems within the same range. But again, looking at the percentages, it actually decreases from 18% to 12%. So at first glance, we thought the business looks good. It's growing by $1 million every year, but it's actually becoming less profitable. So that's where this analysis can come in really handy because the further you dive in, the more information you're going to get about the company. So because we rely on financial statements to establish trends, if the financial statements are unreliable or perhaps misstated, they could significantly impact any calculations that we're doing for damages or loss of profits. Generally speaking, you want to look at a minimum of 3 years of historical information, preferably 3 to 5 years, to give you a better sense of what happened with the company, to establish patterns or assess whether a level of revenue or profit is sustainable. This slide shows a graph of 10 years of historical revenue levels for a company from 2007 to 2017. So what do we see when we look at this graph? I see a moderate revenue increase from 2007 to 2012. So that's from 0.1 to. I see a pretty sharp decline in 2012 to 2013. So this is definitely an anomaly year. I would want to understand what happened in this year. Did the business close for a part of the year? Did a competitor open nearby? Did the business, shut down some segment of their operations? Something changed, something impacted this business in this year. And then we see a rebound essentially after 2013. So we see an increase from 3 to 4. And again, what happened? What caused that increase? What did the business do to offset that decline? And then finally, looking on the right-hand side from points 4 to 5, the revenues start to become moderate again. They return to moderate growth. They're leveling off. So based on this, if we were trying to project revenues after 2017, which years would we want to use as our basis? There's a few different options. You have to consider your judgment here. So if we're looking at the last 10 years, I'm looking at the bottom section of this slide here. The growth rate is 7% over the last 10 years. If we look specifically in the last 5 years, the growth rate is only 3%. If we look at the last 4 years though, and we're excluding that year of decline, it's 11%. Just that year of decline was a negative 24% drop. So it really depends on what period of time you're looking at. It can have a pretty significant impact on any projections you're doing if you're trying to estimate what the business would do after this. Based on just this very limited information that we have on this slide, I would say that basing my analysis on the last 3 or 4 years, so from 2014 to 2017 or from 2015 to 2017, that opinion the most reasonable. It seems like whatever happened in 2012 and 13 and 14 was an anomaly and not representative of their normal operations. So if I was projecting after 2017, I would be looking somewhere around, so if I'm looking at from 0.4 to 5, that's about a 7% growth. That's most likely what I would use in this situation. And that is what I have on the introduction to financial statements. So now I'm going to pass it back to Natalia to give you an overview on some valuation topics.
Thanks, Katherine. That was great. I think I learned a thing or two there. Just going into a basic overview of valuations. The Canadian Institute of Chartered Business Valuators, the CICBV as they're coined, was established about 50 years ago in 1971 as a result of the introduction of capital gains taxes in Canada. So it's a relatively new profession. And over the past 50 years, a lot of regulatory changes have created valuation requirements in different contexts. but the same valuation principles apply throughout. So some examples of various types of valuation engagements would be, for example, legal or tax transactions, estate planning transactions, or business reorganizations. We have accounting standards, purchase price allocations, goodwill impairment tests, audit assist. We can have valuations for transactions, for mergers and acquisitions, going public or going private. And last but not least, valuations for litigation purposes. So that can be a business valuation or a damage quantification. So as you might imagine, Deloitte specializes in all of these areas, but the valuations for litigation purposes is what we do in dispute advisory. So valuators are increasingly called upon to provide expertise in litigation matters involving valuation of business interests and economic losses, valuing damages. Expert and valuator are referred to interchangeably. This particular audience might be more familiar with the term expert. They can be synonymous, but experts don't necessarily have to be valuators. So someone that has been qualified in court doesn't necessarily have to have a CBV designation, but it's the most technically applicable designation. So just getting into just a high-level overview of the concept of value. So the definition of fair market value is important to understand. It's defined as the highest price expressed in terms of cash and cash equivalents between a hypothetically willing and able buyer and seller acting at arm's length in an open and unrestricted market where neither is under compulsion to buy or sell and all parties have reasonable knowledge of all the relevant facts. So what is acting at arm's length? Parties have to have opposing interests to be considered acting at arm's length. So a simple example of a sale of a business between two strangers, note the word strangers, the buyer and seller would have opposing interests. So the buyer would want the price to be lower and the seller would want the price to be higher. So in that scenario, we can say that those parties are acting at arm's length. So all of these inputs that define fair market value underpin a lot of the assumptions that feed into our valuation conclusions. So they're important to understand. And just comparing price versus value. So the distinction on if we're dealing with an actual open market transaction or what we as valuators call a notional market valuation, that's the difference between price versus value. So the valuation profession has evolved precisely because there are many instances where businesses are not actually exposed for sale and a theoretical value is required. So the ultimate objective of a value analysis in an open market transaction is price, where the parties do their own research and analysis and then subject the process to negotiation. So basically, the valuation is a starting point, whereas in a notional market valuation, the ultimate objective is to arrive at fair market value as defined. Value assessments are made as at a current date, and fair market value determinations under a notional market valuation can be made at current date or some historical date. So does price equal does fair market value equal price? No. And the answer is because of our fair market value definitions and assumptions. So going back to those, in an open market transaction, the parties could in fact have different strengths and negotiating abilities, whereas in a notional theoretical valuation, we're not actually exposing the business for sale. We just don't have that information. We don't know who is at the table. So in absence of that information, we have to assume the parties have equal negotiation skills and resources. Similarly, in an open market transaction, we might often see non-cash considerations, such as stocks or other perks that aren't cash, whereas our fair market value definition expresses the value in terms of cash. In an open market transaction, there may be constraints. The parties might not be fully informed or prudent, or they might not be arm's length parties. in an open market transaction, there may be a for sale or purchase. So, for example, say you were retiring this year in January because of health issues you were experiencing, and now COVID has hit. If you didn't have health problems, you could theoretically maybe wait for this to pass, wait for the dust to settle, and then retire. But the reality is you have this problem and you don't have the luxury of doing this. So in this instance, you might have to accept a price that's lower than fair market value. And that's something that we would define as a for sale, or maybe there's some compulsion to transact. I'm going to hand this back over to Katherine.
Okay, great. Thanks, Natalia. Okay, so our next section is really just going to be an introduction to valuing losses, so what we call economic loss quantification. So now that we understand a bit more about the financial statements and how to interpret them and the concept of value, we're better equipped to estimate the economic losses suffered by a business. So two conceptual types of economic losses to consider are temporary losses and permanent. So temporary is when businesses suffer a reduced income, but they still continue to exist, and they can potentially regain some of their previous income levels. So they're able to do some sort of mitigation. On the other side, we have permanent losses, and this is where a business will cease or terminate some of its operations completely, or the business was never even able to commence operations, if we were speaking about, let's say, a startup company. In terms of measuring the loss, there are two different methods that you want to consider. So when a business is destroyed or impacted as a result of the wrongdoing, you can look to assess the damages by either looking at the lost profits or the lost business value. So when we're looking at either method, you want to consider the but for and then less the actual. So what would have happened but for the event being could be a breach of contract, a wrongdoing, an accident. So what would have happened but for that, so normal results, less what actually happened as a result of the event. Under the loss of business value method, the remedy applied is to essentially think of it as if someone has to purchase the destroyed or impacted business from the owner at its fair market value at the date of loss. So this value, it's equal to, if you think of all the cash flows that would accrue to the owner of that business over its lifetime, the value would be equal to the present value of all of those cash flows. That would be the business valuation method. Under the lost profits method, one forecasts out the annual profits for the impacted business based on the actual economic and industry conditions from the date the damage starts up to some point into the future. It could be a date of trial or just another designated date. And so a fundamental difference between the two is the expected duration of the loss. Lost profits are a measure of damages typically utilized when the business continues to operate but suffers a reduction. And the measurement is calculated for a period until the business regains its position that it would have been in. So here on this slide, we talk about, the quantification of economic losses. So economic damages usually involve a loss of profits. It could also include a loss of wages and earnings, both past and future. It could be the loss of future earning capacity. You also could have damage to real and personal property, and then finally a loss of value. So the economic damage quantification is the measurement of these damages, which often results from a harmful act. So there's further considerations, what is the alleged wrong? An example could be a breach of contract situation between a business and a supplier where, let's say, the supplier doesn't provide the products that it was supposed to in time. This results in a business not being able to fulfill a contract with a customer, and the business ends up losing that contract with the customer. So in that case, we would want to quantify the loss of profits associated with that contract. So if we move on to the next slide. So this is a graphical depiction of the simplified lost profits calculation. So again, the formula at its most simplistic form is the but-for profits minus the actual equals your loss. In this graph, the fixed linear line going from going from bottom left to top right, that represents your but-for projected profits. It's the expected profits, including those from, let's use my example from the previous slide, including those from the contract. The dotted line represents the actual profits that the business occurred. So you can see after an event, the profits decline, they stay down for a while, and then eventually they start to rebound until they meet up again with the projected profits line. So that green shaded area, which is really the difference between the projected profits and the actual profits, represents the business's loss associated with losing a specific contract. So an added complexity to consider in determining lost profits, and Natalia briefly touched on it before, is the current COVID crisis. So how is this going to impact calculations of lost profits going forward? So it's a very interesting question. You know, what happens when the past performance, we discussed that, you know, we looked at our revenue trend analysis. So what happens when our past performance and our forecasts of a business, its industry, and the economy have essentially no bearing on future performance? The COVID-19 pandemic has caused us to really consider this question. So in this example, we have really simplified it, but basically the COVID resulted in the company having to severely limit their operations. Therefore, we consider this in our projections, which is illustrated by the dip in the but-for projections line. The green section again represents the loss of profit, the difference between the projected and the actual. And this blue section now has been added. The blue section pertains to the impact on actual profits of COVID. So speaking to COVID specifically, there are a lot of factors that would go into an analysis of lost profits. This is just a highly simplified example to illustrate the impact. But because there are still so many unknowns associated with the overall extended impact of COVID, there's things that we've already been considering on our end on how to consider this impact in any files or calculations that come up. And a few thoughts initially that we've had is, the first one would really be to engage an economist. So our opinion is, economists are best positioned to predict the impacts of COVID-19, and that independent financial experts, such as ourselves, we're best positioned to turn those predictions into loss calculations. In the absence of economist predictions, because we understand things are still unfolding, we would definitely recommend scenario analysis. So in terms of putting together a calculation for a lost profits, instead of just doing one calculation based on one set of assumptions, we would definitely want to start incorporating multiple scenarios under the idea that there is still so much uncertainty and we can't really be sure what will happen. So we want to present a range of a loss depending on different assumptions. And then a third consideration that we've given is in terms of when you're doing your loss of profits calculation or a loss of business value calculation, you would utilize higher discount rates. And so those bring the amount that we're calculating into the present value terms. So when you use a higher discount rate to do that, the higher the discount rate, it represents a greater risk associated with the uncertainty of our future projections. So those are kind of our initial thoughts on the impact that COVID is going to have on disputes calculations going forward.
So I'll jump back in here. So as discussed in the last couple examples, the but-for scenario, we provided a very simplistic depiction, but the but-for scenario is really critical, particularly with litigation accounting, because it's so litigious. It often requires us to align with counsel and just align with the legal theory of the case, causation. So too often we see loss quantification that's disjointed from the alleged wrong. So an example of that in the last slide, that Katherine presented was the COVID crisis. So if a projection did not include that dip for COVID, potentially the but-for projected profits would be overstated, and that would be an oversight. So it's not necessarily, we need to put on our independent hats on and think about critically, what would the business reality have been, and segregating, items from the alleged wrong to what the realistic scenario would have been. So the appropriate but-for scenario is an art, not a science, and professional judgment and deep business and industry understanding is important. But the most important factor is the reasonability of our assumptions. This leads us to talk about normalization adjustments. So normalization adjustments seek to eliminate any unusual or non-reoccurring items. So as the name suggests, we want to normalize for outliers. And we do that in the income statement. Why? Why do we normalize? We're striving to make the most realistic assessment of business value or losses, and we want to eliminate all the noise and items that might distort the true value, especially if they're not expected to continue into the future. When do we normalize? We normalize when we observe unusual non-recurring items on the income statement, or items that are not reflective of their fair market value. So the remaining slides attempt to explain the when, how, and where of normalization adjustments. So now we've gone through all the theory, want to give you some live concrete examples of how you can assess when your client's financial statements might not be reliable and when you might need to make a normalization adjustment. So by way of overview, businesses usually have incentives, and sometimes they have the means to minimize their net income. It's done in two ways usually, either by understating revenue, so unreported income, or by overstating expenses, padding expenses, if you will. So this slide provides a general overview for things to look out for in assessing when financial statements might not be reliable. So just going through this, you want to consider what business do they operate in. Unreported income might be more prevalent in small service-oriented companies. You want to consider whether they're a single owner operator or whether there's other partners involved. If there is other partners, you want to consider, are they friends or family members, or are they truly arm's length? An arm's length party would probably have more difficulty. It would be harder for that business to collect cash because you essentially need to get an arm's length party on board. And to be clear, unreported income is tax evasion and is illegal. And you also want to look out for whether there is a history of negative earnings or volatile earnings, up and down earnings, large non-recurring items. It kind of begs the question, like, if you had sustained level of negative earnings, how are you surviving? And lastly, is there an allegation of unreported income? Is your client telling you that there's unreported income in the business? So just going into some techniques of how we would estimate unreported income. We would look to industry statistical averages, whether business earnings or individual earnings. We could impute income from annual expenditures. Imputing income is a method used by the CRA when they audit taxpayers, and we'll get into a live example of what that means. And then we can also look to documenting cash sales if appropriate. And the last method is testimony evidence that falls more within the legal strategy of the case. So some simple first steps that you can identify. Let's use this example here. So you're a family lawyer and your client's soon-to-be ex-husband is the sole owner and operator of a residential landscaping business that employs 2 full-time landscapers from April to October. So let's consider whether opportunity exists in this scenario to collect cash payments. So this person, in this instance, there's a sole owner operator. So it's much easier to get away with collecting cash payments. As mentioned, arm's length parties won't necessarily want to take on that risk of, that committing tax fraud. Secondly, this scenario, the clients are residential clients, so they might be willing to pay cash to avoid paying tax. In this scenario, the employees presumably go on EI from November until March, so they might be willing to accept cash payments during months of ramp up or ramp down, like from April and October, where the business is just getting going, so that their EI doesn't get clawed back. So it's not called being jaded, it's called being professionally skeptical. So I think all of these flags point to that there is potentially an opportunity to collect cash payments. And we've perked up to the fact that it's there. So next we want to compare what the actual reported income was as compared to statistical earnings. So we can see in this example, the business reported income of $17,000 to $22,000. Whereas when we look at the stats say on average, businesses in Ontario, landscaping businesses, make about $43,000. It's not to say every business is going to make that amount. We're just using the stats as a guide, as a benchmark to see if there's any red flags. So normalizing is really quite straightforward. It's basic arithmetic. So we've got our statistical earnings. We've got what the client is actually saying that they've earned in their reported earnings, and we have the delta, the variance between the two. So we can see a range of potentially unreported income can be between $20,000 to $25,000. Now note that we're rounding here. Rounding is important because exact figures imply precision, and by definition, this exercise is not precise. So this is an example of where we would normalize, and this would be an adjustment on the income statement. So next question, how do you get the stats? So as Katherine mentioned, Statistics Canada puts out a lot of really robust data that's accessible and free, and it's just very rich with a lot of detail. So in this last example, you would want to find what's called a NAICS code, North American Industry Classification System. So this is a code for all businesses generated by Statistics Canada, and you can find it simply by Googling NAICS code for the business in question. So once you have your NAICS code, you would click and go to the Financial Performance Data website. It's a Government of Canada website, and you would click and create a report. After that, you would choose the options that are most comparable with the business in question. So in this instance, you can select revenue between $30 to $5 million or $5 million to $20 million. You can select your Canada or a province and incorporated versus unincorporated or everyone. The next step would be setting the parameters on how you want to see the data. So you can choose to see it in thousands of dollars or percentages. And lastly, you take your NAICS code that you've found and you can put it in there and generate the data. So that's kind of an example of what a high-level normalization adjustment looks like. In this example, we are normalizing for market value of wages and salaries. Now, this is a common line item that we normalize for. It's found on the income statement. And what we want to do is we want to reflect the fair market value of the wages and salaries. So continuing with the example, you're a family lawyer and you're helping your client through divorce proceedings. And she tells you that she's helped her husband with admin duties from April to October, working about 15 hours per week. Her T4 shows she was paid $50,000 per year. That seems like a great salary for very little work. So we can dig into this and you can use the same technique, just looking at individual stats. And you can see that full part-time salaries for general office workers in Ontario is about $44,000. So at a quick glance, it seems a little high, especially since your client is telling you that she only works part-time. And when you look at the part-time data, you can see that it's much lower. So in this example, the net effect, the normalization adjustment, is pretty significant, $37,000. And we would normalize that again on the income statement. So just to give you an overview of how to find this particular data set, you want to look for what's called an NOC code. It's a National Occupational Classification. So it's a code, again, generated by Stats Canada. You can find it by Googling. And the data tables that provide the data for the income stats are, again, available online for free. And in this particular example, we can just search on the top right corner of the website, of the StatsCan website, for keyword searches. You can type in income, earnings. This particular data table is appropriate. It includes the employment income by NOC code, by gender, and by level of work activity. So you can set your parameters and filter for your appropriate criteria. So Canada or the provinces, gender, work activity, and there you have your data. So another example of normalization unreported income is an example of a client who's a personal support worker for the last 20 years, who was catastrophically injured in an accident. So you're a personal injury lawyer and you have advised her that she has an income loss claim. The problem is her taxes show very little income. It just doesn't make sense. She was working full time for the last 20 years, very little income. So probably there's some unreported income there. If you pull the applicable stats, you can see that full-time workers make about $28,000 a year. So you can kind of see that there's this potential range of unreported income in the $20,000 to $22,000 range. Now, this analysis is great, but you might be thinking, okay, so it's hard. How can we support that other than saying, that she's earning at the stat? There's not a lot of documented support for that. So another method that we've used is to impute her income. So in talking to this claimant, we've understood that she has not only supported 3 kids, but had a mortgage and a car and worked full time and never received any social assistance. So she definitely made enough to support herself and her family. So we can estimate what her income would have been based on her annual expenditures. So we can show it as pulling the stats on what an average household in Ontario spends in annual expenditures. This is from StatsCan. The first column here is from StatsCan. And then we can adjust for what we estimate this particular claimant's expenses might be based on our conversations with her and her personal circumstances. So we can see that after making the appropriate adjustments, we have corroborated these 2 data points are generally corroborative of one another. So the data here in this instance supports each other. So how to find that data? Similar, I'll just run through that. The data here was, we were looking for annual expenditures in Canada, or in this case in Ontario. So it's the same StatsCan data, where we go to this website here and you can just quickly search household spending. In this case, we selected this data table showing household spending by provinces. And you can add or remove, click on this button, add or remove reference period to, again, set your appropriate parameters. So you can set it to the year, the geographic region, and it gives you a whole breakdown of various expenses, as you've seen. And that is how you generate your data. So again, there's a lot of very detailed and very robust information on Statistics Canada available to all. But the important thing is really corroboration. So we've used these two methods to estimate the level of unreported income, but do they tie to one another? And if they hadn't, that would be a problem. We would need to look into that further, and potentially one is not supportive of the other. So corroboration is a critical step, and really it's fundamental it's that last data point that will conclude, that might allow someone else to conclude that your calculations are reasonable.
Okay, great.
Okay.
Thanks,
Go ahead,
Natalia.
Katherine.
All right, I'm going to take over, and we're just going to, so now that we have gone through our analysis, we just wanted to touch briefly on how do we present our findings. So there's 4 common types of reports that are issued by chartered business valuators. So these reports are standardized in accordance with the CBV Institute. So we have a valuation report, an advisory report, expert report, and limited critique. So there are two other additional reports included in our standards. They're called the Fairness Opinion and the Investment Entity Review Reports. These have been added in recent years with a very specific type of engagement in mind. So we're just going to focus on the 4 that are on the screen for our presentation. So the first one I wanted to touch on was our valuation report. So the valuation report essentially concludes on the value of the shares of a business, the assets of the business, or a specific interest. And there are differing levels of assurance provided depending on what type of valuation report is used. So ranging from highest to lowest, we start with the comprehensive report, then it's called an estimate, and then finally a calculation. So the difference between the 3 is really the amount of investigation that is done. So a calculation report would be really not much more than just taking the financials that we are provided and running through to calculate the business value. An estimate, we would do a bit more corroboration, some research into industry and trying to gain a little bit more comfort on the figures we've been presented. And then the comprehensive is the most extensive. In all of those cases, the author of the report is to be independent, and it essentially calculates the fair market value that we discussed previously. The advisory report is a little bit different. So in this case, the author is not required to be independent. This report is actually used more in a consulting fashion. So the author acts as an advisor to legal counsel, and the report would not be presented in court as evidence. So the goal here was really to review independent expert reports, provide comments, and to assist with coming up with responding questions.
Okay, so next we have expert reports. These might be the reports that you're all a little bit more familiar with. So they quantify economic losses as a result of an event or wrongdoing. And the goal is to calculate, support, and conclude on the quantum of economic losses. So the keyword being support, and it all needs to be reasonably supported. That's the test. A good expert report simplifies issues, distills issues, and really the methodology is transparent and the conclusions are easy to understand. So it needs to be written in a very simple and straightforward manner that will allow the reader, whether it's a judge or a lawyer, to really understand what you've done and gain comfort around your conclusions and the assumptions that you've made. This report definitely requires independence, and in fact, independence can be challenged if there's any sort of appearance of that you're taking on overstepping and taking on a little bit too much of an advisory role. That's a huge no-no. The last report is called a limited critique report. It's a report that provides the comments on a valuation expert or advisory report, but does not conclude on value. So the goal here is to poke holes in evaluation or an expert report challenge the assumptions, note the weaknesses, and ultimately with the aim that the court or the trier of fact place less weight on the other side's report, the report that you're critiquing. So to keep in mind, limited critique reports do not provide a valuation conclusion, so the usefulness in court could be limited, and independence in this instance is still required. So really the only time that independence is not required is when you're acting in an advisory capacity. And this slide just provides an overview of the types of litigation assignments we work on. We like to say that basically anytime there's a dispute and there's lawyers and money involved associated with the breach or the wrongdoing, we can help quantify damages from purely a financial perspective. So while what we do is quite complex, the art is really how to simplify it. And that concludes our presentation. So I just wanted to open up the floor to any questions.
So I see we actually do have a question that came through. I'm just going to read it out. So what factors or considerations are used to calculate goodwill? My personal interest is in determining goodwill for a small law firm like mine, where we have short-term files such as wills and real estate. So the calculation of goodwill is actually fairly complex because goodwill is an intangible asset. It is a little bit challenging to figure out what the value is associated with the goodwill. There is an accounting standard that outlines a very kind of complicated calculation, but essentially you can think of it as like the difference between any consideration that's transferred from a buyer to a seller, and then the net identifiable assets that are acquired. So there is a lot more that goes into it. You have to consider controlling interests versus non-controlling interests. So I'm sorry, it's not so much a quick answer in terms of a very easy way to calculate goodwill. There is a lot of considerations that have to go into it in terms of the actual accounting of it. If you're looking more for like high level things that would be considered in goodwill, you would definitely consider like relationships of owners of the business. You would consider any sort of long-term contracts that you might have with clients or suppliers. Things of those nature would all be qualitatively, factored into your measure of goodwill. So I hope that gives you a little bit more information on what is considered in calculating goodwill. Okay, we see another question here. This one, Natalia, when or why is a limited critique report used and how are they helpful?
That's a good question. So often, I know there's some court decisions, and I don't know off the top of my head which ones they are, but I know that there was a couple of decisions where, you're poking holes, but then the judge it begs the question, okay, well, what is your opinion? And so that's why sometimes it's limited in its usefulness. So when would we use a limited critique report? Well, sometimes it's a budget constraint where you might just want to highlight the weaknesses. Maybe it's strategy. So maybe the other side is really just, you feel like the numbers are quite reasonable and there's not a lot to poke holes at. And so maybe you just want a couple of little nuggets to poke holes at. And sometimes it's, Katherine, you might be able to speak to this more, when you're on a side where you just wouldn't have the access to the information.
Mm-hmm. Yeah, so this actually kind of ties into another question we received. So I'm just going to read it out and then I'm going to answer it at the same time. So for family law matters, would you consider it more useful for both parties to have valuation reports done rather than the party that owns the business? They do the valuation report and the other party has a limited critique done. So for that situation, it really depends on what you're after. So you have to remember a limited critique report is just that, it's limited. So if one party does a valuation report, their report is the one that is proposing a value of the business, whereas the limited critique report, let's say that option was chosen to respond to the valuation report, It's just going to, like Natalia said, poke holes or point out areas that might not be jiving or that might, require further questioning, but the limited critique report will not offer its own responding opinion of value. So it really depends on what you're after. And speaking a little bit more to valuation reports themselves. So again, it depends on the context that you're using it for. So I know I was retained on an engagement to do a valuation report, and we actually had a bit of back and forth between myself and the client on what valuation date to use. So in that circumstance, there was a shareholder that wanted to exit the company. So they were trying to determine a value of the company in order to buy that shareholder out. And so the appropriate valuation date for the purposes of calculating damages would be the date that the shareholder left the company. But in that circumstance, our client just had already had a report done at that date, and they wanted a valuation of the company done at a current date. And so in that case, that report wasn't done for damages purposes. It was done just to provide an update on the value of the company. They were trying to show that the company had actually declined in value over time. So there's a lot of different considerations to consider when you're deciding what type of report you need and what your needs are. Hopefully that
I'm just going to jump in with the last question with the limited critique. So keep in mind, you can hire an expert to do an expert report that still pokes holes. The only difference is they kind of close the gap, and then they conclude based on where they're poking the holes and what their opinion is on the assumptions. An expert report can do both. It can poke holes while concluding on a value. So in that instance, it would be a value that flows from the critique points and presumably might meet your needs.
Thanks, Natalia.
Any other questions?
So if we don't, I guess this is Veronica, if we don't have any more questions, then I guess we could probably conclude the presentation. I really want to thank Katherine and Natalia for the amazing presentation. It was very informative. And we will make so we have recorded today's webinar, and it will be available on the YouTube channel for the Canadian Hispanic Bar Association. And we'll also try to get the slides to you as well. And yes, if you have any other questions, feel free to reach out to Katherine or Natalia, and hopefully they can answer those questions for you.
Yeah, thanks, Veronica. We're happy to take questions now or later. Just reach out to us whenever.